All right. Hi, friends. I'm really excited to be chatting with my friend Peter, who's been my financial advisor for a while now, and I've known you forever. So thank you for coming on my show.
Thanks for having me, Kathy.
I've got a really good lineup for the next few weeks here. Next week, we're going to be talking about branding. So my friend from Now Radio is going to come on and talk a little bit about branding. If you have any questions about that, let me know. And then following week, I've got my amazing accountant who's going to give us some tips. And I think, Peter, you're the one who introduced me to Jennifer. She's freaking amazing. Like, I've had, two others before that, and like night and day. You can't even compare. And then I've got two inspectors that'll be joining me at the end of the month. So really good lineup. And I think I'm going to be bringing back Felix on rental properties. I got a request on doing a talk about what rental properties, how that works, how to look for things, or how do we deal with the financial side of things. So that'll probably be coming soon. I don't have that scheduled yet, but Felix is on board. But for today, I've got Peter Lee, and he's going to talk about a topic I don't think it's talked about much, especially on the real estate side. And I usually am pretty, I usually like to promote it just because I think it is important. And financial planning is always something that we should look for, but it's really not talked about enough. I think anytime it's money issues, it's just not talked about enough. So Peter, I'm really glad you're here and to tell us about a few things. Really, one of the biggest things I talk about is mortgage insurance versus life insurance, and I hope you'll touch on that today.
Yeah, thanks, Kathy. It's never the fun topic when it comes to finances is to talk about death and taxes and disability and illnesses. But at the same time, it is one of the most important things. So, when it comes down to it, it's the foundation of any planning is to make sure you're mitigating all the risks that are associated. And it's all about the what ifs. Nobody plans to, get into an accident. Nobody plans to get sick. But it happens. And because it happens unexpectedly, to prepare for that and to prepare to make sure that your family's taken care of is something that, it has to be talked about more often. But of course, there's no natural transition or a fun transition from showing someone a house or, helping them get a mortgage and then to talk about insurance, right? So the three types of insurance that everyone should be aware of and should look into are, life insurance, critical illness, and disability. Today, we're probably going to talk more on the first two, life insurance and critical illness, as you obviously mentioned, mortgage insurance being something you want to talk about and discuss. And so with that, kind of get into it. Life insurance. So really, it's about the short-term and the long-term outlook. Everyone has both needs and they're different. So, at the end of the day, one vehicle or one product does not suit someone's need today for the rest of their lives. And you can't, it might change. It's going to modify over time and life events are going to change that. But, thinking about short-term, you have things like mortgage, you have debts, you have income replacement, final expenses, and children's needs to be kind of the main categories of why you need life insurance short-term. However, long-term, you still also have a need where there's estate planning, final expenses, and wealth building. And these are obviously very different from the short-term needs, but that's something that still kind of applies to everybody, regardless of, whether you're making millions of dollars or, you're kind of working for, an average professional job and, making 70 to 100,000. You're still going to have some sort of estate planning needs because obviously if you're doing some good planning of saving and looking to retire, you might have things that you're going to pass on to your kids. whether it's real estate, whether it's, other assets like investments and so on. And there's a component of thinking about how do you pay those taxes and transfer that on. But of course, mortgage insurance would really fall under that short-term liability. And so, it's a topic that's covered regularly enough, but still a lot of people aren't aware of it. And, if you don't talk to anybody in the insurance industry, you can go by years without ever really understanding why, there's so much controversy with mortgage insurance versus regular life insurance. And so the simplest thing to understand for everybody out there that has mortgage insurance is the fact that, you don't really do any real underwriting to get that mortgage insurance. You're going to be at the bank getting your mortgage, and you're going to have, a pretty, convoluted, very legal form that asks you a lot of questions about your health, and maybe some questions that maybe you probably shouldn't be allowed to answer on the spot without maybe calling your doctor. So you're filling out this form saying, I haven't had these health issues and so on, and therefore, based on your ticks, they're going to say, yeah, you've been approved. You can have this insurance. So they haven't done any, vitals. They haven't checked your blood pressure. They haven't drawn any fluids to see, if you're lying about smoking, or maybe there's some levels of things that are high and not average. And those are things that are generally done in real underwriting for an insurance policy. And yet they don't do any of that. So what does that mean? They do that after post-mortem. So they do that after you pass. So think about the questionnaire that you check off boxes of you claiming to be healthy today, and something happens, 10 years in, and maybe the checklist that you checked off that I don't have these illnesses don't apply to you because maybe you did develop, an ailment, and now you are diagnosed with something right before you passed. Well, they kind of now have this loophole of, well, you told us you didn't have this, but you have this, so we don't have to pay this out. So that's kind of the big controversy, is that because they're underwriting after the event, they don't really have to always pay that out. And the other big disadvantage is the fact that they're only covering the balance of the mortgage. And what happens over time? What's most people's objective when they borrow money to buy a house? They want to pay off the debt, right? So your mortgage balance is going down, and obviously over time, less and less is covered. And so if you think about that, that's not really a good deal, that you're paying this flat amount, but you're constantly, knocking down the debt that you owe, right? So that's the only thing they pay off. And so when you look at getting proper coverage and you go through, a licensed insurance advisor or broker, is that you got to go through the underwriting process. You can't pay any premiums until the insurance company wants your business because they think it's a worthwhile business. Insurance companies aren't into making bad business, meaning, they don't want to give insurance to people that they're going to make a claim on, very likely. And so, but of course, the advantage is the younger you are, you can usually qualify for life insurance if you're in good health, right? And so by going through that process, they can't take that away from you. So once you qualify, whether you develop some sort of ailment or any sort of diagnosis that could impact your ability to buy insurance again, doesn't impact the fact that if something happened, the insurance company will pay out. They don't look at it afterwards to see, hey, how do we get out of this one, right? Of course, there's obviously the normal causes of, if you were any fraudulent claims, or, you lied about something like that before you applied, right? Or if you were, if you passed, during a crime, there's obviously certain scenarios where they don't pay out, but it's pretty straightforward. As long as you were truthful when you applied and you fully disclose everything, and something happens later on, they pay. And that death benefit doesn't change. That death benefit doesn't decrease later because you paid down more debt. So what does that mean? Well, there's more that goes to your family, right? So you're not going to be mad about that. So no. That's the advantage. So, and most times I've seen historically, when someone is insurable, they're healthy, it's always cheaper to actually buy term insurance through an insurance company than buying mortgage insurance. So there's very little advantage to ever really buy mortgage insurance,
So there isn't, like, in your mind, is there any reason that somebody would choose mortgage insurance rather than life insurance? Is there any situation?
There's never really a reason someone should, but you know, I never ever suggest someone to cancel an existing policy, even if it's mortgage insurance, until they qualify for new insurance. So in the event that they can't qualify for their insurance on their own through going through the underwriting process, holding on to the mortgage insurance, there's still at least a glimmer of hope that maybe it could work out in your favor. But you're kind of banking on a bit of luck there. But that's always kind of the rule of thumb, is you never cancel anything until you've been fully approved for something else that is more advantageous. So generally not, but obviously, I would never tell someone to cancel it until for sure they can qualify for their own coverage.
Okay. So I've got an interesting question on here. I'm not really sure how to attack this, and I don't know anything about it. What's your advice on reverse mortgage? Like how would that affect insurance?
Sorry, what do you mean by reverse mortgage?
I don't really know much about reverse mortgages. But,
yeah. Okay.
That's the question.
Right.
What's your advice on reverse mortgage? I'm guessing in terms of insurance with somebody who has a reverse mortgage. Do you know anything about
Honestly, I do not. No,
Okay.
I don't deal with reverse mortgages, and I personally haven't dealt with one, so I don't know if I can really comment on the insurance need of that.
Me neither.
Yeah,
I'll have to look into that. I don't think that's common, and I don't think that's something that's financially is advisable.
Well, the reverse mortgage idea and the strategy, there's some validity of kind of really you're capitalizing on the equity you have in your home, right? So then you're kind of really borrowing against the asset that you have. So I imagine the insurance that, again, a lender would charge, because at the end of the day, if we just think about it, just the technicality of it is that you're going to now have a growing debt over time that's going to fund your retirement, right? So I would imagine they would probably have some sort of cap as to loan to value of what your home might be worth. So we're going to lend out maybe 70-80% out of that. And we'd like to have life insurance on it so that for any reason somewhere along the way, but the fact that they've tied it to your asset, I imagine that should be enough security. So you can't necessarily buy life insurance to pay them, especially if they've already secured the asset to it. But I again, so it would just be a matter of what's the need of insurance there is.
Yeah. I think there's a better product than, like, if you pre-plan. I think there's a better product, like an insurance product, that would cover that rather than using your equity, right?
Yeah, and the people that reverse mortgages cater to, obviously they're really trying to speak to the retirees and some of the people in that demographic that are not looking at their retirement funds to be sufficient, right? So they're going to tap into their equity. I can imagine, obviously, the lender that provides that program would want to insure for just additional guarantees. And at that point, they may not be insurable. So there are some challenges I can just naturally see with age and health. So they might have to maybe stick to the mortgage insurance if that's what's offered at a reverse mortgage. So I've never dealt with a client that done that. But, the whole strategy around the reverse mortgage is to just, you're doing almost a home equity line of credit, but not, right? That's all that is conceptually. So even though I maybe can't answer directly, I can only imagine there's some angles of, the lenders want to cover their debts a little smarter. That's all. And that's kind of
pre-plan, so you don't need to do the reverse mortgage.
Yeah. Side note is, yes, plan well so that you don't have to defer to the reverse mortgage.
Yeah. I know that my mom has got me to have life insurance since I think it was 18. So is that something that's common? Like, when do most people get life insurance, or when should people start getting life insurance?
Yeah, I think parents are always somewhat proactive, and they probably, learn that lesson of understanding time can be to your advantage. as an adult, and you kind of realize, oh, you made it be cheaper if I bought it earlier. So they kind of try to pass that on and try to encourage their kids. And obviously sometimes parents will set up insurance for their kids when they're not even of age. And there's great advantages for that. As to when someone should buy life insurance, there's got to be a need, right? I don't like creating needs that aren't there, right? So for somebody that's single, do they need life insurance? Not really. Where is that money going, right? However, if they have the intention of, I plan to have a family in 5 years, I plan to be married, and these are things that I plan to do, and I have a mortgage, then there are some value, there's some merit of buying some insurance anyways, knowing that, even though you're single, but if you have debts, maybe you'd want to make sure that house is paid off and maybe it gets passed on to your parents. So everyone has different kind of ideas of what they want their succession to be, but also how they want to pass some of their estate on. So, the answer, it's never an age related. It's more so of kind of a life event of, when you're buying your first home, when you're getting married, or when you have a significant other common law spouse that you have some, vested interest of protecting income. And then those are all good enough reasons to obviously start thinking about planning, because the one thing that isn't to everyone's advantage is that health does not kind of stick around to whenever you need it to be convenient, and neither does age play to be an advantage as you wait longer. The longer you wait, unfortunately, it costs a little more to buy life insurance. And of course, your health doesn't always naturally get better with age. So with that going against you, again, the sooner you qualify, it is in your advantage to have a cheaper rate, get the coverage that you can get at a much cheaper rate, so you can get a little more coverage too. So you can kind of plan ahead better that way.
Yeah, I think because I was 18, I think my policy is like $28. I mean, it doesn't cover much, but that's pretty good.
And the younger you are, you can do more, more efficient planning, where you can buy permanent life insurance, which can obviously address that long-term need. And you can do it at a much cheaper cost. And so there are some advantages of looking at that when you are younger. And if that's something that you're interested in, or again, you want to know what all the things that you can do. And, I've met some very keen clients through my life where they want to start planning early, and all the power to them, right? But if, life comes at you fast, and you have a lot of different things to take care of, and with multiple life events, whether it's getting married, having children, starting a family, buying permanent life insurance isn't something I recommend immediately, just because, I think you've got to be in a good position to plan for that. But having some permanent insurance is something that everyone has to think about, though.
Okay.
Yeah.
So I've been doing some research. So if people have insurance coverage through their employers, do you think they need to add on that?
So good question. Employment coverage from employers, so group benefits. Generally, usually when you apply for life insurance or any insurance, the insurance companies don't really validate that to actually be considered anything. And so if that gives you a sign, and reason for that is, are you going to be with your employer forever? And today, how common is that? And so the thought process is, the day you leave, that coverage ends. That doesn't follow you. So if you kept relying on first your employer to cover your life insurance coverage, you'd hope that you're always going to be employed by somebody that provides it. But also, most people don't realize they don't really get a ton of coverage through their employer. Unless you're at a C-suite level of being a CFO, CEO or something, most companies will offer maybe 1 to 2 times salary, which isn't really a ton of coverage. Nowadays, I don't imagine that would cover their mortgage even, right? But not only that, it's really cheap for the companies to sponsor and give these small policies, because all they're doing is buying 1-year term coverages, because they don't know if you're going to be around next year. So the chance of them paying out is super minimal. And so for coverage amount's sake, it's not enough, but also you don't control, if you decide that after 10 years, now you need to buy your own life insurance policy. Well, again, it's going back to that main concern of age and health. And so do you want that to be, a point of risk where, maybe you can buy it when you really think you need your own? So there's always a huge advantage of getting your own coverage. And I usually always let clients know that, this stuff you get from your employer, it's a bonus, but that's not going to change anyone's lives. It's not even going to pay your debts off a lot of times. So you can't really treat that like it's something you're going to keep forever.
Yeah. No, I've had clients where, parents passed and they're left with all this debt that they have to deal with. And, it was just more of just like they're already dealing with the overwhelm of a parent passing, but now they've got to deal with all this debt that they've passed on as well. Right. So just those two things together, like it just made it, even worse. Right. Like you shouldn't have to worry about that when you're dealing with a parent passing or any family member passing.
Yeah.
Right?
And you bring up a really good point. And, obviously this is a good reminder where a lot of people don't quite realize the whole process when someone passes of what the toll it takes on, mentally, emotional, but in the end, it's all going to be tied to financial as well. And so, it's a morbid conversation for sure, but at the same time, do you want it? It's always the big question is, how do you want your family to be taken care of if something happened unexpectedly, not at your deathbed when you're 100 years old? That's a different story. But if it happened unexpectedly, how much time do you want them to take off so they can go through this process to deal with it? And does it make sense that they need to somehow figure out how to pay for bills 2 weeks after, right? Let alone paying for funeral expenses and so on. So it's definitely an easier conversation when someone's had to deal with something like this. But that's part of the education process that I go through with my clients is to, have that candid conversation of, do you know what's going to be involved? And even if you have family members that can help out, like what's it worth to not have to bother anybody or to have to depend on anybody? What's that worth? And you just kind of can't really beat the price of life insurance. And that's kind of why, people have always relied on the insurance companies. It's to hedge the risk of you can't afford to cover everything, unexpectedly. Right.
Yeah. I almost feel like, this should almost be mandatory, right? Like you can't get car insurance. You have to get car insurance if you want to drive. So I feel like this is one of those things like if you have a family, you should have insurance kind of thing, right? But
a really good point. Did you know that in Australia, it's a part of their social program that everyone has some life insurance. Actually, it's pretty neat.
See, that's great.
Yeah, but again, not saying that we need
you to plan.
Yeah, and again, that comes down to, I think, we have to educate the mass to make sure they understand where the resources are, and to make sure they plan ahead, because this can go down a totally different spiral of rabbit hole into talking about financial education in general. But protecting your family, your loved ones, it's something that gets missed because we don't want to talk about negativity or morbid things of why would anyone be talking about that, right? But as you get older, hopefully you start recognizing that you're not invincible, right?
Yeah, no. Even my mom's got insurance on all her grandkids already. So
yeah.
She's just a big believer. But so one of the things that I typically struggle with, and you probably know this, like, how much insurance do I need?
Sure. It's not like everyone has a set number that you can determine based on their age or anything like that. But it's a multiple factors, right? Everyone has specific needs. It's a very custom plan for everybody. You got to look at debt. You got to look at final costs, right? It's not cheap to have have a funeral or a burial even. Mm-hmm. And again, we kind of think that, that's going to be taken care of by somebody. Well, who's going to pay for that, right? And then children's needs, especially if it's short term, right? You have young kids in the family. Well, you're not working to just hope that they're just going to go and join the workforce. Maybe you want to provide an opportunity for them to get some higher education, right? Or to, pursue whatever dreams that they want to pursue. But all those things come at a cost, right? But it's not just that, but it's the most important thing that most people miss or don't think about is the income replacement side of things. They don't realize the human capital, how important and how valuable that is. They just think about, well, my mortgage is this amount, and I want to make sure, my car payments are done. And they don't really think too much about what else after that. So when you really deal with an insurance advisor and they go through the process to understand, well, what's the income that we got to replace? Because you're not in the picture anymore. And that's something most people don't think about. And that's what sometimes might surprise some people to go, oh, I did not think I needed this much insurance. But really, $1 million today for an average family, it doesn't really go a long way when you start thinking about how much income they have to protect, right? If they're making $70,000 to $100,000 a year, $1 million is, with an average mortgage these days of what, $500,000 for someone in more mid-class, right? That's not going to go very far. So that's where some of the surprises come out. But, with a good explanation and logic behind where does this money go and how does the family take care of themselves afterwards? And do you want to put a limit as to when they got to figure out how to figure out an income source, especially if it's, a stay-at-home mom, for example, and a breadwinner. Those are all things that you have to, consider. And then, even without inflation, some of these numbers sometimes might surprise people when it's the first conversation when it comes to how much insurance they should have.
Yeah.
But, it should make sense.
I mean, it's great to have the house paid off and cars paid off and all that stuff. But I mean, you still need to be able to afford to live. So you still got to feed yourself. You still got to pay property taxes, which are increasing like every year, right? Like even those people who, win those $1 million dream homes, right? At the lottery homes, great. A lot of people are like, woohoo. Like I just won $1 million basically. But then how many of those people can actually afford to move in? Right? Because property taxes are high, utilities are sky high, right? You gotta plan.
You can't retire by winning one of those homes.
No, you literally are forced to sell it if you don't have the income to basically pump into this free house. You can't live for free, right? So So this income that you have to take care of is definitely something that, myself, I'd be like, how do I even calculate that? So especially with mine, where income for us, I mean, it's up and down, but like there's still a minimum every year, right? So I don't know. I just let you kind of figure that out for us. So what do I got here next? You mentioned about permanent insurance. When should someone get permanent insurance versus term?
For the majority of times, term will suffice for most people's needs, especially when there's, debt involved that isn't lifelong, right? Permanent does have a place in everyone's planning though, because naturally, your need changes. Right now, if you have a young family and you just bought your first home or your second home, your needs for the next 20, 25 years, it's going to be massive, right? You got that income replacement, you got your debt components, children's education, things like that. But once, you're an empty nester, the kids are out of the house, your debt's paid off, your mortgage is all done for, and you're living the good life, it's a totally different need at that point of, well, who's going to pay the taxes on the estate so that my kids can get it? Or, do I want to donate some to charity? How, again, final expenses, that doesn't ever disappear, right? So there's going to be a need of some permanent insurance for everybody. There's no doubt that, you can't rely on term forever, right? Unfortunately, the two things that are certain, as Jennifer, the next professional guest, will talk about, are death and taxes. And so, those are two things that are something you can't avoid. And so when should someone get permanent? Obviously, it's got to make sense cash flow wise. Timing is probably important because, like I mentioned earlier, you just started a family, you just bought your second home. There's a lot of things you're thinking about. You're saving, you're saving for education, you're saving for retirement, you're paying for all these things and children's programs and other things. And so maybe permanent insurance isn't, the first thought that you have, and nor should it be something that should be pushed on somebody. But should they set it up, before it's too late? Absolutely. A lot of term coverages, if you're getting it with a big enough carrier, are convertible to permanent policies, meaning you don't have to show evidence of insurability. You don't have to do another blood test, urine test, and go through the whole process. So the nice thing is you don't have to qualify. But of course, the age that you convert, that's going to impact how expensive it is. So the longer you wait, it does get more costly. And so obviously, having frequent check-ins with your insurance advisor to see that, hey, is it something we should look at, converting some to permanent this year or next year? Maybe not every year, but every few years you should have that discussion to start addressing the fact that, again, it's probably smart to do this now than to wait till you're 60 and realize it's very expensive to buy permanent life insurance. So, yeah.
Get it early to get it cheap. Get it before you get any type of illnesses, right?
Well, you don't have to get it before you get any illnesses, yes. But the nice thing is, a term can be converted anytime. And so, another question just off topic there is, how long of a term do you get, right? Mm-hmm. For the simple concept of the whole mortgage insurance idea, if one of your biggest debts that you're carrying around is your mortgage, obviously you probably want to match your term length to your amortization period. And so, whether that's 20 years, 25 or 30 years, and probably not 30 years these days anyways, there are carriers that offer, 20 and 25-year terms. I usually, would try to sway people from picking the 10-year term, because then 10 years is never long enough. But of course, if some people are really strategic and they're really diligent, you can buy a 10-year term that can convert into a 20-year term by year 5. So you can kind of create a 25-year term. So that's a bit of a trick, but you got to be pretty diligent on it. Your advisor has to be diligent as well to keep on top of it to make sure by year 5 you can convert it. But I know a lot of people would rather just set it and kind of forget it. And getting a 20-year term or a 25-year term would be sufficient for most people.
Yeah. Most of it, people would rather just do it, kind of one and done kind of thing rather than having to keep up. I know I have one client that recently purchased. I was like, oh, you could save like $20 if you did this. And you could save, another $20 if you did. She's like, no, I just want it all in one. I'm fine. I'm like, oh, well, okay, sure.
Yeah. And, and again, on that note, I think today the prosumer of people that can do research and so on, when it comes down to it, a lot of advisors work differently. Some people will chase the rates, right? Just as some people chase mortgage rates, right? Yeah. But most advisors will, have a good reason as to why they might recommend certain companies over others. Mm-hmm. There are merits of sometimes going with a bigger company that has a better suite and more expansive suite of permanent products that you can convert to. Mm-hmm. And sometimes the smaller guys might be more competitive at the term rates, but they have a lot less options. So it's never a perfect world of apples to apples per se. Does it come down to you saving $2 a month? Is that for the greater good versus having a better flexibility later on? Those are things that I always talk about too. So,
that's exactly the same as what Felix mentioned last week, right? Don't always look at the rate.
Yeah. So don't chase premiums. Don't chase rates. You got to look at the full picture of what you're getting. And I think that's a safe bet, even to a simple analogy of houses, right? You don't just buy the cheapest house, because obviously you're going to get what you pay for.
Exactly. So here's an interesting topic to throw at you. Because marijuana is so readily available now, and so many people are buying edibles or trying it out or whatever, just recreational use kind of thing. Does that affect the ability to qualify, or like what are the repercussions if you have policy and you start, doing something like this?
Sure, great question. So the insurance industry, for the longest time looked at people that use marijuana to be considered smokers. Of course, they've progressed, and they're trending with understanding more about it. And obviously, now that it's legalized in Canada, makes a big difference as well. So, using cannabis actually is no longer considered a smoker status. And so, for those out there that have policies that they got as a smoker because they used cannabis in the past, you can get that smoker status removed. You'll have to go through some questions. And so, someone that uses cannabis today would not be considered a smoker, which is great because smoker rates are quite expensive. And however, I will put a disclaimer. The insurance companies do look at lifestyle pretty seriously when people use cannabis. So they will look at things like, driving records, right? And because the biggest thing they're concerned about today is risk factor of abuse of certain products that leads to, potential claims, right? So they will look at that. So just because it's legal and you're not considered a smoker doesn't mean, you can use all the cannabis you want and get a life insurance policy, no problem. Just like anything, like even alcohol and so on, there is a way to look at everything, and they will look at the risk as to whether it's a good risk for them or if it's a bad risk. So it doesn't mean you're always guaranteed to get life insurance if you had bad lifestyle choices that, is considered a bad risk to the insurance company.
Okay, so not a bad idea to just call and double check to see if you can lower your rate.
Yeah, for those, people that have bought policy that, admitted to using cannabis and they were rated a smoker, yeah, they can get that smoker status removed, which will save them a considerable amount of their premiums.
Awesome. If anybody still has any questions, put them in the comments so that we can get to them. I think we're nearing the end here, but still got a couple more questions for you, Peter.
Okay. Well, you know what? I figured maybe it'd be good to maybe transition. You had some really good questions for life insurance there, but I thought at least to add extra to it is I think critical illness needs to be addressed, and it's something that, again, I'm a big advocate for, just because you think about the amount of people that needs to be a little more educated on life insurance. I think critical illness deserves a bit of spotlight and some time as well. So maybe we'll kind of get to that, and if there's some questions we can come back to afterwards, that'd be great. So critical illness insurance, it is a little more of a progressive insurance planning. And I say progressive just because, 20, 30 years ago, our parents didn't really deal with this kind of insurance because back then, when you were, diagnosed with heart disease, you had a heart attack or a stroke or had cancer, people didn't survive. And so unfortunately, the technology and the healthcare just wasn't where it is today. And so it really was more so just kind of part of life insurance per se. But you look at today, the survival rate is astronomical. In fact, most people will easily survive a lot of life-threatening situations just because of technology, medicine, and healthcare. And so the problem is then what happens? Because even though we have some great, medicine and healthcare, the aftermath of some of these diagnoses, doesn't allow you to go back to work right away. And sometimes it might be a limited time that you're dealing with where, you don't really go back to ever being normal. And that's kind of the challenge, is how do you fill that gap? And I think it's safe to say, when was the last time, someone had a friend within their network, family member, someone within their network that has been diagnosed unexpectedly at a young age, whether it's a tumor, cancer. And when you're unexpectedly diagnosed with something like this, and there's costs involved, what do you hear about most? GoFundMe pages, right? We try to rally up friends, and it's really great that we can do that. But I think about what kind of planning could have been done to prevent that, right? And so, if it's big takeaway for me is to be able to at least share so that people think about this and, try to learn about it to make sure they know their options. I think that's a huge, advancement to making sure that people are more educated and aware of what they can do to protect themselves, right? Because that's one of the biggest things that I cringe, and I, when I hear is people, setting up GoFundMe pages because the family is not in a situation that they can afford, to go down to get the best healthcare, because that's usually not free. It's not part of public healthcare. If you don't have the time to wait for a donor for certain things, right? And not only that, we're really privileged and, blessed to be able to live in a country where our healthcare is great, but not everything is covered if you had to deal with things like cancer.
Mm-hmm.
There's a lot of post-treatment care that is not free, and it's very expensive. And so the impact of getting sick, and there's 25 illnesses that, that's been defined, and it's a benchmark that most insurance companies share. But the big ones are, heart disease, cancer, stroke, right? And I'm not going to get into stats today, but when it comes down to it, if it happens, what's your solution? What's your plan if you can't go back to work for 6 months or 2 years, right? What if you have to, take yourself and go find the best doctor for it, and they're not local? How do you pay for that? Or how do you bring family close by, right? And, it's kind of sad, but if one person's sick in the family, you're impacting the whole family. The spouse doesn't continue on with their lives. They're actually helping you get better, and they're more involved in your health than just you, right? And so the impact, it spreads quite quickly. And so the financial side of that, of dealing with this, because you're still alive, it's, it can vary, but I guess that's where, is your rainy day fund? Is your rainy day fund, sufficient to protect and, provide for the family for that scenario, right? So unfortunately, insurance is still the best solution for most people, because, they just could not fathom. You can't get the returns for that. I deal with a lot of, professionals, medical professionals, dental professionals, and high net worth individuals. And, I work with a portfolio manager that, they're really good at what they do, and they can't ever challenge the returns of a critical illness policy through investing. So, it's, obviously everyone's going to have their own opinion, but when, some of the biggest portfolio managers that, deliver great returns to pension funds and high net worth individuals can say that they can somehow self-insure you, that should be a sign that it's probably worth looking into, And on top of that, what if we added a cherry on top and said, if you never use this policy and you were really healthy and you never ended up getting sick, and after 15 years, they give you all your premiums back because you didn't use it, what's that worth, right? What's the loss? And of course, it's debatable. Obviously, there's no return there per se on the money that you put away. But imagine you had to use the policy. That return would be massive then. So, it's something I think everyone should consider.
That's awesome. That's like a nice refund policy, right?
Yeah, I use the kind of the analogy of a forced, savings program.
Yeah.
Where, it's like a bank account, right? Yeah. Nobody really earns an interest in their savings account these days, or a checking account, right? So what if you just kind of tuck some money away, and if you had to use it, you got sick, that worst case scenario, they pay out, and it's a lot more than what you put in. Mm-hmm. But in the best case scenario of your health, you never deal with an illness through your life. Well, you get every dollar back that you put into it. So
that's amazing. I forgot about that part.
Spend your money. Yeah.
So when should someone get critical illness insurance?
Sooner the better. Critical illness is actually a much more difficult insurance to buy. Life insurance would be the easiest, just because, they don't look so closely to things like family history, whereas critical illness, because there's a lot of hereditary correlations to, your parents being diagnosed with something at a certain age being something that they can correlate as to some sort of likeliness of risk to you. The earlier you do it, it's easier to get. And critical illness insurance is not cheap. And the reason for that is because the likeliness of the insurance company to pay out is higher than, them paying out on a term life insurance policy, just because you're still alive. And so as a living benefit, the frequency is a lot higher than death. So therefore, they have to run the numbers and they have to obviously manage the risks appropriately. So it is more expensive. And also, if you think you need it because, maybe your parents have just, gone through some pretty intense hardships. And so you need it because your parents had something, you have a much harder chance of actually getting it, because that's bad business. If they know that, your parents had something and it's kind of, on this trajectory that if they've had it at a certain age, that there's a really high chance you might as well. They don't want to pay claims that, they know they're going to lose money on, right? So the sooner you get it, obviously, the younger you are, the more advantageous it is to know, because maybe your parents aren't old enough and they haven't been diagnosed with anything. So those are all in your advantage.
But don't they also ask about your grandparents? Or just
no, they can't, there's not enough stats to kind of prove that, 2 generations wouldn't be something they can really, validate. So it would just be your parents and siblings mostly.
And how do you determine how much in critical insurance policy to get? Because it's not tied to income, right? It's kind of tied more to expenses, right?
Yeah, good question. And so there's a couple ways to look at it. I think some people, you can get super technical and think about here's the things that I need to manage for a couple of years. And it might be the income side of it, right? It might be the debt side. But there's never a perfect real, one formula that works for everybody. But I find that sometimes, getting a multiplier of your income is still a smart move, just because we could talk about the best case scenario of, you having a stroke, but you're not massively affected, right? And maybe you still go back to some sort of normal living, within a month or two, right? But we talk about the worst case scenario of, you've been diagnosed with a life-threatening cancer and you have a year to live, right? What would you want to do, right? And so it's something different for everybody. Maybe it'd be to bring family close, right? It'd be to travel the world, right? So what do you need to do those things, right? So everyone will have kind of different mindset of what needs to be achieved if something were to happen. And so at the end of the day, having something is better than nothing. Mm-hmm. So, similar to permanent life insurance, if you want the type of policy that gives all your money back if you don't use it, it is a little more expensive. And so therefore, does it make sense in your budget to have this policy, right? But this is ever more so important to everybody, including people that are single, because this isn't for your dependents. This isn't for somebody else. Mm-hmm. This pays you while you're dealing with it, meaning it's for you. So it's something that everybody should have.
So should you get this before you even getting life insurance?
Well, for someone that doesn't have liabilities, for sure, this would still apply to them, right? Like critical illness insurance, I think applies to everybody, because, if you were to get sick, you would be impacted financially, right? Yeah. And the life insurance question, well, it depends. It probably goes hand in hand if someone's going through those, life events of purchasing their first home and, getting married and so on. You're going to need life insurance to cover, like I said, the short-term and long-term needs. But the critical illness should be highly considered to be integrated, to be something you want to set up to make sure that you're okay.
Yeah.
And I know that disability.
I know we put that on the back burner forever, and you kind of had to chase us to kind of get that in place to have us protected and all that stuff. And I was just like, yeah, okay. But no, I think it really took us understanding of the effects of one of us not being able to work and having the other not being able to work, because we had to take care of the other person. So that's 2 incomes that would be affected what would that look like? And to us, it was like, holy crap. Yeah. Like,
Yeah.
we don't have a backup plan if we don't have that.
Yeah. And, obviously my best clients for critical illness are physicians, because they see this. I don't have to sell. I don't have to convince them. They get the reality. They see it day to day, right? And so they're my best clients because they go, yeah, this is obviously very important and I need to get it, right? And so when, the medical professionals are getting it for themselves, hopefully that should be some sort of, indicator that everyone should think about it at least, right? And not enough insurance advisors talk about it enough, because I think the industry, or sometimes people might think that, oh, I don't want to keep selling things to my client, or I don't want to try to pitch things like that. But for me, I'm a huge advocate, just because everyone needs it, and I don't want to be in a position where my client says, how come you didn't sell me this, or how come you didn't set this up for me, right? So it's kind of our duty to make sure we inform our clients everything they risk of losing income, protecting their family, and dealing with a financial situation. I gotta do my job to make sure they know the risks and make sure they understand what they can do to fix it. So
absolutely, you're not selling them if you truly believe that this is a necessity and something that they need, right? So absolutely, bug me every day until I get the point, which I think you kind of did. But sure. So thankful, because we never know what's going to happen, right? So
absolutely. Yeah, that's exactly the only thing we know. We don't. Nobody can predict, when they're going to get hurt or when they're going to get sick. Unfortunately, right? Yep. No one can time that. Otherwise, there would be no need of insurance.
Yeah. Yeah. And the nice thing to know about this is, we're really healthy, and that's probably why I put it off for so long, right? We're active, we're athletes, we're all athletes, we're fine, right? But yeah, we just never know. And then knowing that this is kind of a forced savings account, that's really good. I feel like you don't even need to sell it. It's like, oh, okay, here, just take my money. Just put it away for me. But thank you very much, Peter. I think we learned a lot. I hope people got lots of value, and I hope people stop thinking that talking about finances is such a faux pas. I really think that it's really important that we talk about it with friends, with their kids, everybody. And it's really just to protect them, to teach them how to protect themselves and protect their families. So thank you very much, Peter, for coming to chat with us on that. And I think I'll post. Do you have a link that I can share with people if they want to get in touch with you, and if they had some questions or want to start planning?
Yeah, you can share my email with them, and they can kind of get in touch with me and go from there. Did I?
Okay. So if anybody has some questions for Peter or want to start planning and protecting your family, DM me and I'll send you Peter's details. All right. Thanks so if there's no more questions, is there anything you want to add, Peter?
No, I think we covered a lot, and I can't imagine everyone's wanting to talk more insurance at this point. I enjoy talking about it, and it's necessary, but it can definitely be. I can't be the life of the party with insurance conversations, so we'll end it here. Thanks so much for having me.
So I will let you get to your golf game.
Thanks. Have a good day.
Thank you. Have a great day. Bye.
Bye.